All right. I'm going to be doing a problem over accounts receivables with sales discounts and returns, and I'm going to be comparing them across the gross and net approach. So here we have a problem. We have a company that's using a perpetual inventory system and offering credit terms of 2, 10, and 30. So to start with the gross journal entries. On July 1st, the company sells merchandise to Bright for $50,000 on account with terms 2, 10, and 30. So we know that because they're selling on account, accounts receivables are going to go up by $50,000. And that also means that their sales revenue will go up by $50,000. Now, because they're using a perpetual inventory system, we also have to update the cost of goods sold at the time of sale, kind of like a constant update, constantly updating it. So cost of goods sold will go up by the 30,000, or the cost of the inventory. And then their inventory will go down by the amount that they sold, 30,000. It's important to note that the reason we're using like the full values here, the full 50,000, the full 30,000, is because we're using the gross method, which does not assume the customers are going to take advantage of the discount. So we're going to assume they're paying full price, and then if they pay within the discount period, that's when we will apply the discount and subtract that amount from the full payment, or the original payment price. So then on July 3rd, they're going to sell merchandise to Smart Buy. So we're just going to pretty much do the exact same thing. This time for $20,000. Their sales revenue will go up by the same amount. And then we're still perpetual, so we need to update the cost of goods sold. This time, you can see it cost them $12,000 for that inventory. So their inventory will also go down by 12,000. So then moving on to July 8th, Bright returned merchandise worth $5,000 at a cost of $3,000. So this is within the discount period still. However, no cash has actually exchanged hands, so we don't have to worry about discounting anything because no one's paid for anything. So the account we're going to use here is sales returns and allowances for $5,000. And this means because of returning it, that means they're no longer going to owe the amount of the merchandise they just returned. So we're actually going to credit their accounts receivables by that amount because they no longer owe $5,000 because they've returned it. And that also means the inventory is being returned to Ashby. So inventory cost them $3,000, Ashby. And that means their cost of goods sold is going to go down by $3,000. This account right here, sales returns and allowances, is a contra revenue. So this is going to ultimately reduce your net sales. If you remember at the very beginning of the income statement, you have your sales revenue, for example, at the very top. Then you might subtract sales returns and allowances, and then maybe even sales discounts, which we'll be doing in a second. So as you know, revenue accounts have a natural credit balance, and this being a contra revenue will have a natural debit balance. So then on July 9th, Smart Buy pays their account in full. Now it's important to note, Smart Buy bought on July 3rd, so they are within their discount period, so we need to account for that and actually apply that discount for them. So they're paying their account in cash, or paying in full basically. So we know they owed $20,000, right? But because they're paying within the discount period, we have to give them that discount now. And so what we can think of is we're discounting them by 2%. So in other words, they're still going to be paying the other 98%. So we can just multiply this by 0.98, and that'll give us 19,600. And the easy credit to this is their accounts receivables. We're going to credit that and reduce it. However, their accounts receivable balance was 20,000, so we need to still reduce it by the 20,000. So that leaves us with a unbalanced journal entry, and the way we fix that is with this account, sales discounts. We could just find the difference between these two values right here, or another way to look at it is we take the amount that they were owing, or the amount they owed, and we're just gonna multiply that by the discount, 2%, and that's gonna give us how much of a discount they actually got. And then you can see if we highlight these two and look down here, equals 20,000. That equals our 20,000 for the accounts receivable. Like I was saying earlier, the sales discount is also a contra revenue account, so this will also reduce net sales ultimately. And so for the same reason, it's a debit balance because it's a contra revenue account. So then July 12th, BrightTech pays the remaining balance on their account. However, BrightTech paid or bought on July 1st. They are not paying within the 10-day discount period, so this is going to be a straight up kind of one-for-one journal entry. Again, they are paying cash. They owed $50,000. Sorry, no, not $50,000. We have to remember, BrightTech did a return, so you have to kind of keep that in mind. They originally owed $50,000, correct. However, they returned $5,000 worth of merchandise. So they actually gonna owe $45,000 in the end. So after we've received the cash or debited the cash, we need to credit their accounts receivables because they're no longer gonna owe us any more money. And the exact same logic. Their original accounts receivable balance was 50,000. And then we subtract that by the 5,000 that they returned, and that gives us 45,000. And that's pretty much what the journal entries would look like under the gross method. So now under the net, we're gonna do the same thing. However, with the net method, we have to remember we're gonna go ahead and assume all the customers are gonna take advantage of the discount from the start. So let's see, we know our accounts receivables are gonna go up. Or Ashby's accounts receivables are going to go up. They paid or bought 50,000 on account, but again, we're going to net that of the discount. So we're actually going to only have them paid 98%, at least right now. So that's going to leave us 49,000. And then sales revenue has to match. And then because we are still doing the perpetual, cost of goods sold has to be updated. And then inventory has to be decreased by the same amount. Now, the reason the cost of goods sold does not change here and inventory does not change, they're not discounted, is because the discount only applies to Ashby's customers. Ashby, as you can see right here, is the one offering the discount. So Ashby themselves are not getting a discount on maybe the cost to buy their merchandise or inventory, or the cost to create or make their inventory. So for them, there's not going to be a discount. It's going to remain the full price no matter what, across gross or net. So July 3rd is going to be pretty much the same thing, just for Smart Buy. They bought $20,000 worth. We got to multiply that by the 0.98 to take it, or to account for the discount we're assuming they're going to take advantage of. And then sales revenue just has to match. Cost of goods sold is going to go up by 12,000. Still no discount for that. And then inventory has to go down by the same amount. So then moving forward to July 8th, BrightTech returns merchandise. Now again, this is within the discount period of the original purchase date. So this is still going to be discounted. We have to make sure we kind of keep this in line with what happened up here, because we discounted it at the very beginning. So if we didn't discount this $5,000, we'd basically be returning more than they paid for on account, which doesn't make any sense. So this account is going to be the exact same. And we're just going to discount this by that 2%. And then again, their accounts receivables are going to go down by the same amount. Now, Ashby's inventory is going to go back up by $3,000. Again, we're not going to discount this amount because Ashby is the one giving out the discount, not receiving the discount. So yeah, inventory will go back up and then cost of goods sold will go back down. So then on to July 9th. Smart Buy pays their account in full within the discount period from July 3rd. It's not been 10 days yet. So we've actually already accounted for this. Under the net approach, again, we already assume they're going to use a discount. So this is like the easy one-to-one journal entry. So cash goes up by 19,600. That's how much they owed. And then their accounts receivables go down by 19,600 because they paid it off in cash. And then last but not least, on July 12th, Brightech pays their balance. However, Brightech does not pay within the discount period. So we now have to kind of add back the discount they didn't use, or in other words, the discount they forfeited. So we know their cash is going to go up. So like we did under the gross method, we're going to subtract the original amount owed by the return right here. And that's going to give us 44,100. However, this is still with the discount applied. And because they didn't pay within the discount period, we have to add the discount back. So up here, if you remember, we multiplied this by 0.98. So we're just going to do the inverse of that. So we're just going to divide. And that's going to give us $45,000. So this is how much they ended up having to actually pay because they didn't pay within the discount period after we subtract the sales returns. So you know the credit here is going to be accounts receivables, of course. So we can do the same thing. We just take the accounts receivables minus the sales returns, and that gives us 44,100, which, as we can see, is not balanced. So the way we fix that is with sales discounts forfeited. Now, again, we could just find the difference here, or we could look at it this way. We take the amount that they were owing us, or Ashby, and we multiply that by the 2%. This is how much, this is the discount they gave up by not paying within the discount period. So as you can see, this equals the 45,000. We're balanced. This is an other revenue account, so that's why as a credit balance, this will appear after your regular revenues and regular expenses. This is in the other revenues and other expenses afterwards. Another way you could think of it is kind of like an interest gained account where Brightech held onto their money longer, and so they had to pay more, aka $900, because they held onto the money longer. That's like the interest accrued almost. It's just another way you could kind of think about it. And that's pretty much it for the net approach. As you can see, across gross and net, you do end up with the same ending balances. So the cash, how much Brightech actually pays is 45,000 under the gross. They end up paying the same amount under the net. Smart Buy ends up paying 19,600 under the gross, same amount under the net. The difference is just kind of where the discounts get split up, as well as some like the revenues are a little bit different too. So under the gross approach, your initial revenues are going to be higher. So here we see they had a sales revenue of 50,000 and 20,000, but under the net it was 49,000 and 19,600. However, under the gross approach, you have to discount or take back some of that revenue with the contra revenue accounts of returns and allowances and sales discounts later on. So we reduce our revenue later, versus the net, you start off with the lower revenue stream, but you get to add that back under the sales discounts forfeited. So the gross, higher revenues at the beginning, you take away from it, versus the net, lower revenues in the beginning, but you get to add to it later. And I have a real world example here. If I can get it to pull up. There we go. So this is Alamo Group Incorporated, a company I found under the Edgar search database. This is a quarterly report from September 30th, 2024. Now, if we go to their notes, accounts receivables. So we can see here, accounts receivable is shown net of sales discounts and the allowance for credit losses. So the big thing we're kind of focused on is shown net of sales discounts. They're basically doing the net approach, what we just did. And that's further emphasized here. at September 30th, the company had $18.3 million in reserves for sales discounts compared to $24 million at December, related to products shipped to our customers under various promotional programs. So basically, what this is saying is these promotional programs are opportunities for the customers to take advantage of a sales discount. It's like this is the kind of like the 210 and 30 type of deal. This is where they could take advantage of a discount. And these reserves are the money they have set aside to cover any customers that end up using a discount. So if we go back to our examples here, let's say Bright Tech paid their let's say Bright Tech paid on time, not on time, within the 10-day discount period. Instead of forfeiting the $900 discount, this $900 would actually be covered by Ashby within these reserves here. The 900 would be, this would have been included in the reserves to account for them taking advantage of the $900 discount. So that's just an example of how accounts receivables can be seen in the real world under a net approach.